have to be open to the idea that the Fed may end up significantly higher.
I think we are likely to see rates somewhere between 5 and 6% before this is over, and maybe even higher.
It's not about the terminal rate. They're still looking at as high a terminal rate as they need to derail inflation.
The Fed does not want to see a replay of what we saw in July. It does not want to see premature financial condition easing on the signs of any Fed pivot.
It's not just up and then back down. The Fed's going to keep that peak in interest rates for quite some time until they actually see improvement in the underlying inflation outlook.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. A warning from Fed Chair Jerome Powell. Interest rates will go higher than originally expected, but the central bank may start slowing the rate of increase next month. Now it's the Bank of England's turn. In just a couple of hours, it's likely to deliver its biggest rate hike in more than 3 decades. And big job cuts on the way at Twitter. New owner Elon Musk plans to eliminate half of the social media company's workforce. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. And Kailey, well, risk assets, they went up, but it was brief, and then they really came down. And we're still dealing with the aftermath of that here in Europe.
Yeah, it wasn't necessarily a hawkish decision, but it was definitely a hawkish press conference, Anna. Jerome Powell making it clear that it's not about the journey, it's about the destination, and the end destination may be a higher terminal rate than we all previously thought. So that definitely weighed on sentiment in the U.S. yesterday. It continued to weigh on sentiment in Asia overnight. The MSCI Asia Pacific Index as a whole down more than 1.5%. In addition to just the Fed overhang, there was also a bit of cold water thrown on the rally and the idea that COVID-0 policy may be on its way out in China. China's top health body reiterating its commitment to COVID-0 policy. So that whole reopening thing may not be happening anytime soon. As a result, a basket of Chinese reopening stocks was underperforming, down about 3% in the overnight session. Then in the bond market, no surprise given the hawkish commentary out of the Federal Reserve. We saw Treasury yields moving higher yesterday, and we've really seen global yields follow suit. We saw a follow-on move in Australia and New Zealand. The 3-year Australian yield and 10-year New Zealand yield each up more than 11 basis points in the overnight session, Kriti.
Yeah, Kailey, stateside, we are seeing, well, futures, they're slightly in the red. You do have that negative bias, a little bit of pressure on risk sentiment, but take a look at this. They're actually flat at the moment. What's interesting to me, though, is after you have the sell-off of almost 2% on the major benchmarks, well, it's kind of natural. There are some technicals that help you kind of bounce back when you have that much of a sell-off. I wonder if that's what we're going to see today. For now, at least, futures, like I said, about flat, not really taking its cue. It looks like they're still kind of maybe pulling back and forth a little bit. The bond market, a completely different story, because that's really where you're seeing money come out very quickly across the curve. By the way, the maturities don't matter here. Take a look at the 10-year yield. We are at not just above 4%, we are at 4.14, 414 basis points on the 10-year yield, up about 4 basis points just in today's session. But look, take a look across the curve. You look into the front end of the curve, the 2-year yield, for example, that move gets more fast and more furious. And as you see that move, especially in the front end, the dollar follows. The dollar is stronger by about 0.5% when you look at the Bloomberg Dollar Index. And traditionally, that would mean that you perhaps see a little bit more pressure on equities. You're not necessarily seeing that, but you are seeing some pressure in the crude space. Remember, NYMEX crude trading at an 88 handle, down about 1.5%, Anna. Okay, so those are the moves stateside. Let's have a look at where we are in Europe then, Kriti, and we have the European equity markets still feeling the after effects, the downdraft of what we saw on Wall Street yesterday. So stocks were severely weaker on Wall Street at the close, and so we factor some of that into our European session today. And it is tech stocks, just as we saw weakness in tech stocks on the Nasdaq yesterday on Wall Street, tech stocks to the fore, and tech stocks are weaker today. Some areas of the banking sector, though, doing a little better as we continue to talk about higher rates for longer. We've got some news here in Europe when it comes to the interest rate hiking cycle. The Norges Bank over in Norway raising benchmark interest rates to 2.5%. The estimate was for 2.75%, though, so that's actually not a hike as big as had been anticipated. And the Norges Bank also saying that they will most likely have to raise again in the month of December. The market taking then a fairly dovish interpretation here. Certainly we saw in the immediate aftermath of this decision some weakness in the Norwegian kroner, and that's what we continue to see there on that chart against the euro, also true against the US dollar. So that's the Norwegian story, not then hiking as
much as had been anticipated. Will we get something similar from the Bank of England? We'll have to see. The pound certainly on the move ahead of that meeting. Here's the weakness in tech stocks I was talking about, down by 1.8% here in Europe. Here's the weakness in the pound, 112.60, dropping by over 1%. A lot of dollar strength to deal with. And so this is really a dollar strength post-Fed story, but it is having an impact here on the pound. And what will be the impact if we see 75 basis points from the Bank of England later, as expected? What if they only do 50? How weak would the pound get then? Sainsbury's, the grocery store here in the UK, up by 3.4%. And this is an interesting theme developing from those businesses that you might have expected to be really affected by the cost of living here in the UK. We are seeing if they manage to stick to guidance, that is actually at the margin being taken as a positive. We saw it yesterday with Next. We see it today in the case of Sainsbury's. And Rolls-Royce down by 3.5%. Some concern around inventory levels, even as we all go back to flying. This is the engine maker, of course. Some concern around inventory levels and some other issues plaguing this particular business right now. Kailey.
All right, Anna, well, let's get back to the Federal Reserve because, as we all expected, they hiked 75 basis points yesterday. But the message from Chairman Powell was, buckle up, we aren't done yet.
We still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
Bloomberg Markets editor Valerie Teitel is joining us now for more. So, Valerie, no doubt about it, Powell had his hawk out yesterday. So why did the stock market initially rally higher after the statement and then he slapped that down?
Yeah, we spent a gut-wrenching 30 minutes thinking that Brainerd might have made some friends. There was an addition to the FOMC statement, and this one line really jumped out at us. The cumulative tightening of monetary policy will be taken into account when they analyze their hiking pace. Now, we spent 30 minutes thinking that this Brainerd pause, maybe she's made some friends on the council. Maybe this is the new norm for the Fed, talking about the risks of hiking too rapidly and a need for pause due to the lags at which monetary policy affects the economic activity of the U.S. But look, make no doubt, Powell came out swinging in his press conference, and he made 4 clear hawkish signals. We have some way to go before we're getting sufficiently restricted. The terminal rate higher than previously expected. This one really hit the equity market and made it turn an about face. And then again, he's reiterating it's premature to talk about the pause. So thinking that this Brainerd pause might have gotten some friends on the council, well, that was a bit dismissed then. And then again, he reiterated over and over again that their preference is to over tighten. They see the risks of under tightening higher than over tightening, and that sure shook the market. The one thing that we're now seeing is that the terminal rate is ratcheting higher. We hit a benchmark of 5% 2 weeks ago, but now you can see that it's not just 5% peak, but we're pricing in now a 5% yield out entire across the 2023 euro-dollar curve. Now this ratcheting higher of the terminal rate, that is going to keep the dollar strong, and we know that this is only going to ratchet higher than 5. Maybe we'll get to 5.25, maybe 5.5 after the NFP print on Friday. If that comes in strong, the expectations of Fed hiking and especially the terminal rate next year is going to ratchet higher, keeping pressure on the dollar.
Okay, yeah, absolutely. That upward pressure clear to see this morning. Valerie, thank you very much. Valerie Teitel with the latest on the market's response to the Fed. Up next is the Bank of England, of course, which is expected to deliver its biggest increase in interest rates in 33 years today. A 75 basis point hike is almost fully priced in by money markets. Bloomberg's Lizzie Burden joins us now with a preview of what we can expect. Lizzie, good morning to you. So a lot has changed, of course, since the last time we heard from the Bank of England. What do we expect?
A lot's changed. What an understatement. We've got a new Prime Minister, a new Chancellor. Trustonomics has been ripped up. It means the Bank of England's got less to do in the inflation-fighting mission. There was a point when markets were pricing 200 basis points of hikes between meetings, an intra-meeting move, and today. Not so anymore. Now markets see almost 75 basis points. That's what economists expect. We did see the Bank of England riding to the rescue of the pension funds with the emergency intervention, the draft dramas over, it seems. 75, though, still quite big. That's because we've got double-digit inflation, labour market tightness, but it's likely to be surrounded by hawkish hints in the presser, in the minutes. In the forecast, we're likely to see inflation coming down. Why? Because of the impact of higher mortgages, the impact to sentiment of all this turmoil, and also, of course, because we've got that fiscal statement coming up on November the 17th. The more tightening the Treasury will do, the less the Bank of England needs to do.
Lizzie, the BOE started active gilt sales this week. Could we hear more about quantitative tightening at the long end of the curve?
I mean, active gilt sales have started this week and it's gone pretty well for the Bank of England. I can't see them wanting to rock the boat at this stage. Economists I speak to say that they're not expecting more details about how they're going to deal with the long end today. But that's also partly because the governor's going to want to make interest rates the active tool. That was part of the mission. So perhaps we will, but I'd be surprised.
All right, Bloomberg's Lizzie Burden, looking forward to your coverage throughout the day on the BOE. Thank you so much. Now let's turn to corporate news. Bloomberg has learned that Elon Musk plans to eliminate about 3,700 jobs at Twitter, or about half of the current workforce. This coming as Cathie Wood of ARK Invest says she's turning bullish on the company, speaking exclusively with Bloomberg's Tom McKenzie at the Web Summit in Lisbon.
This subscription advertising model is a very smart move if he goes in that direction. The verification, that little check, is very important to people and could help clean up the platform considerably.
So let's get to who she was speaking with, Tom McKenzie at the Web Summit. So Tom, obviously a lot of Twitter employees may not be feeling so good today as they await job cuts, but Cathie Wood seems to be feeling good about this. What does she see for Twitter under this new leadership?
Yeah, this is one fan of Twitter, and of course she's divisive in her views. She's though treated like something of a celebrity superstar here at Web Summit, but her views on Twitter arguably have changed because at the beginning of this year her funds were actually selling off Twitter. Now she revealed to us in this exclusive interview that in fact via a public-private fund she has a small position in Twitter under Elon Musk, about $1 million. So she said she wants to expand that. To your question about what she sees in this company under Musk, she said, look, you could get to a point, and she drew on his experience at PayPal, where this becomes a super app with banking services, with finance services built into it. And that is where she sees the optimism. She talked about the fact that she supports him in terms of that subscription model, $8. Again, that's proven controversial. Interestingly, we're also talking to Sir Martin Sorrell, previously, of course, the founder of WPP, the world's biggest advertising agency. He said content and standards is still key for advertisers on Twitter. They want more certainty on that front. But for now, what we're hearing from Cathie Wood is she's supportive of Musk's plans.
Well, Cathie wasn't the only high-profile guest you spoke to yesterday. The First Lady of Ukraine was there as well. Tom, what was she doing headlining a tech summit?
Yeah, interesting. Surrounded by armed security, very tight security for very obvious reasons. What she was trying to get across to the Web Summit here was her message that she wants the tech community, investors, innovators, entrepreneurs to be involved in Ukraine in a positive way. She said, it's time now for you to take sides. We have some sound from her. Take a listen to our interview then with the First Lady of Ukraine.
Technology is a powerful force. You just have to decide whose side you're on, because the technology can destroy and murder, but also technology can be a saving grace for the children who need new limbs, for example, and also for the medical supplies, for energy, for the communities. So that's the key message I've got. It's time for it's a very powerful force. You just have to decide which side you're on.
I also asked the First Lady of Ukraine about the infrastructure attacks that we've been seeing by Russia in cities like Kiev on things like energy, electricity, water. She said this is not impacting the morale. The morale of the Ukrainian people remains strong. She did, though, say that she is concerned about signs of Ukraine fatigue setting in amongst that country's allies, and said that if that becomes entrenched, Ukraine risks perishing, and that, of course, would have significant implications for the world as well. So she's concerned about what she's seeing here in the West in terms of that support and whether that's going to continue for her country.
All right, really important conversation. Bloomberg's Tom McKenzie at the Web Summit in Lisbon. Thank you so much. And don't miss Tom's interview later this hour with Mick Mulvaney, former acting chief of staff for President Donald Trump, who also will be at the summit. All right, well, let's get back to the equity markets and take a look at some stocks moving in pre-market trading here in the U.S. We mentioned earlier the cold water thrown on the whole China reopening speculation after the top health body said they are still committed to COVID zero policy. So as a result, the U.S. listings of big Chinese companies are under pressure in early hours. Alibaba, JD.com, Baidu, each down in the ballpark of 1.5% to 2.7% in the case of JD. Another big mover to the downside is Qualcomm, the biggest maker of smartphone processors. It gave a much weaker than expected revenue forecast. It's getting the hit from COVID zero policy in China, but also just the broader economic slowdown that is weighing on the smartphone market. So as a result, it is down nearly 7%. And it is an even bigger move for another company, Roku, the streaming company, also gave a weak forecast. It is feeling the hit as well from a slowdown in advertising spending. We have heard this from so many companies in recent weeks, but it is taking a big hit as a result, down about 19% before the bell, Anna.
Advertising under pressure, tech under pressure, some of those themes we revisit as we see more hawkishness from the Fed. Coming up on the programme, we'll get a preview of the Bank of England and what to expect. Elisabeth Martins joins us, Senior UK Economist at HSBC. Will we get 75 basis points? What kind of dovish language will be accompanied with that? We'll also speak to Danielle DiMartino-Booth, a former advisor at the Dallas Fed, who's now CEO and Chief Strategist at Quill Intelligence. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. Of course, we're on the heels of the Federal Reserve. We, of course, have the Bank of England decision in just a couple of hours. For our radio audience, stick with me. But for our TV audience, I want to show a chart of what the markets are actually pricing. This could be potentially the largest hike for the Bank of England, I believe 33 years. What's important to know, though, is that this might not be the end-all, be-all. There might still be a long way to go. This is a chart here that shows the Bank of England's benchmark rate about 2.25%, the UK CPI, which has really skyrocketed. We know the cost of living crisis has really accelerated and I want to say been magnified in the UK to some extent. The most recent fiscal policy is not really helping that case either. What's being priced into the markets, though, is still 250 basis points of tightening still left for the Bank of England. And that is going to be a crucial question of whether or not they can deliver that in a way that perhaps kind of harms as little as possible to the economy and to, of course, the working people. Let's get a little bit more perspective here. Joining us now is Elisabeth Martins, HSBC Senior UK Economist. Thank you, as always, for joining us. I want to start with the question of credibility here. The Bank of England has been whipsawed quite a bit. It's been pulled in a bunch of directions. How credible right now is the Bank of England's thinking?
Well, I think the Bank of England's been criticised because it's moved in smaller magnitudes than other central banks. So around the world, we've seen central banks raising by 50, 75, 100 basis points, and the BOE has been much more steady as you go. So it has been slower, even though it started first. There's some credibility issues around the fact that it continued doing QE all through 2021, although, again, so did other central banks. So I think, you know, there is that criticism of it. But as to whether that was right or wrong, I mean, time will tell on that. The Bank of England's been very concerned about the impact of tightening on the economy. And I think, you know, the slowing growth numbers, the surveys, you know, suggest that it was right to have those concerns. So I think that's kind of the jury is still out, really.
OK, so the path has been different. But as you say, they did start earlier. There does seem to be some thinking from various places. And I think you share this view, Liz, that perhaps the Bank of England thinks the market is pricing in too much hiking at the moment. And I think we've actually heard that from one or two bank officials already.
We have, yeah, from two bank officials. One was Ben Broadbent, who's usually very tight-lipped about what he thinks about where rates are going. And one was Catherine Mann, who usually is on the hawkish side, usually encouraging people to expect more rate rises. So both of them have attempted to bring the market down. But of course, we've been on a complete roller coaster in the UK, haven't we? We had the so-called mini budget on the 23rd of September, sent rates soaring up to the sky, and they've come right back down as all that fiscal tightening has come out of the price. So, I mean, it's no wonder everyone's a bit confused about this.
Yeah, absolutely. So there were expectations, as you say, for sort of 2% hikes at one point. That's, of course, unwound.
Yes.
Now we expect 75 basis points today. In terms of the path forward from here, are you going to be watching the split of the votes on the MPC for clues as to whether there is going to be a move towards a more dovish consensus?
Absolutely. The split on the vote is always very interesting. Who's pushing for more, who's pushing for less? And last time we had a three-way split. We had people who wanted more than the 50 basis points we got, and we had one member who wanted less. So the more people that want more, that tells us something about what's going to happen. Actually, I think the risks in this meeting are that the bank will want to, similar to those comments, bring down expectations a little bit, point towards a slower pace of tightening. We've seen that everywhere, actually. We've seen the Fed pointing to a slowdown in the pace of tightening, the ECB perhaps moderating expectations as well. And I think the Bank of England will be in the same boat. So perhaps more votes for smaller hikes than 75.
So there's the pace, then there's the ultimate destination, which is the message that Chairman Powell was trying to give yesterday, that ultimately the terminal rate could be higher. And when he was asked why the thinking changed, she basically said, because inflation isn't going down in the way we thought it would. It is proving very difficult to rein in. What degree of success do you think the Bank of England is going to have in reining in demand and by extension cooling prices?
Well, I mean, I think it's a combination of Bank of England tightening and also the cost of living squeeze, which is reining in demand already. We can start to see that in the surveys. I think we probably are already in the start of a recession. The problem is, does that bring up unemployment and bring down wage pressures, which is the piece of the puzzle that's really concerning the BOE. Other parts of inflation actually look a lot better in terms of goods price inflation, commodity prices, shipping costs, that kind of stuff. That's all moving in the right direction. But what the bank's worried about is that core side, wage pressures, and that's much harder. And I think the worry is, in terms of those imbalances in the labour market, it will take some time for those to play out. So companies have had such a hard time in the UK getting the staff that they need in the last kind of couple of years, and they'll be reluctant to let people go. So I think, wage pressures, and particularly in this inflation climate where people can say, my food bill's up 14.5%, people will be demanding higher pay, and that's the bit where I think it will be tough.
Well, I'm glad you outlined some of those struggles, because this is coming as well as the currency continues to weaken and weaken and weaken. Quickly, as a final question, let's talk about purchasing power here. How much is that going to eat into consumer sentiment in the UK?
Well, consumer sentiment, is already rock bottom. If you look at the GfK Consumer Confidence Index, it's telling us that we've never been so depressed here in the UK, not in the pandemic, not in the global financial crisis, not even in the winter of discontent. So people know that things are quite bad. I don't think that's matched in the spending numbers yet. If you look at the restaurant data, those still show that people are still out and about, going out and enjoying themselves. I think as we move into next year, unfortunately, inflation will still be with us, higher mortgage costs will be with us, higher rental costs, and now higher interest rates as well. And I think that probably does, continue to weigh on sentiment, and perhaps more than the sentiment in the survey start to be matched in the actual spending data.
All right, Liz Martins, HSBC Senior UK Economist, thank you so much for joining us. And don't miss our interview with Andrew Bailey himself, the Governor of the Bank of England. That's at 12 p.m. Eastern, 4 p.m. in London. Now, keeping you up to date with other news from around the world, here's the first word. In China, the National Health Commission says the zero-tolerance approach remains the strategy to fighting COVID. That comes after unverified social media posts boosted hopes that the policy would be eased. On Wednesday, China reported the most new COVID cases in more than 2 months. The U.S. has condemned what it said was the test launch of an intercontinental ballistic missile by North Korea. The launch came a day after Kim Jong-un's regime fired off at least 23 missiles. The State Department urged North Korea to stop the launches and return to talks over its nuclear weapons program. In Brazil, President Jair Bolsonaro called on his protesting supporters to dismantle hundreds of roadblocks. He said they harm the economy and aren't a legitimate form of demonstrating. Supporters of Bolsonaro also refused to accept his defeat in Sunday's election and have taken to the streets across Brazil. And President Biden asked voters to consider the future of democracy when they vote in next week's midterm elections. In a speech not far from the Capitol, the president urged Americans to reject what he called Donald Trump's big lie, denying his election defeat in 2020. Democrats are trying to stave off the potential loss of their majorities in Congress. So it's just a reminder, Anna, that as we contend with all of these different monetary policy decisions and economic data points, there's political risk to consider as well, with the midterms coming up quickly here in the U.S. next Tuesday.
Yeah, absolutely. We've started those conversations with some of our guests, haven't we, about what the midterms might mean for investors. We'll continue to do so as we move towards next week. Danielle DiMartino-Booth joins us next, a former advisor at the Dallas Fed, who now is the CEO and chief strategist at Quill Intelligence. Lots to talk about in the aftermath of that press conference by the Federal Reserve yesterday. What did she make of the move away from focusing on immediate rates to the terminal rate? We'll get into that conversation shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. A warning from Fed Chair Jerome Powell. Interest rates will go higher than it originally expected, but the central bank may start slowing the rate of increase next month. Now it's the Bank of England's turn. In just a couple of hours, it's likely to deliver its biggest rate hike in more than 3 decades. And big job cuts on the way at Twitter. New owner Elon Musk plans to eliminate half of the social media company's workforce. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta in New York. Matt Miller is off today. And Kriti, one of the big focus, of course, coming out of the Fed press conference yesterday is a renewed focus on the terminal rate. And we've seen analysts slowly revisiting where they think interest rates are going to get to. And there's been a suggestion from, I know, a number of our colleagues on the Markets Live blog that reassessment is something that could drive markets for a few days.
Well, it could, and it likely will. Remember, one of the bull cases that was forming for the equity market was this idea that the terminal rate, or at least the expectations of it, kind of hovering around 5%, was stalling out. In the absence of that, you're going to see a little bit of pressure on the stock market. The stock market sell-off that a lot of people said it's probably overdue to kind of turn around. Nevertheless, today you have the S&P futures down about 0.1%. What's interesting, though, is this follows, of course, an almost 2% sell-off in the S&P 500. This is important because now you start to see futures kind of fighting against these technical factors. That what it wants to do is bounce. When you have that big of a sell-off, you bounce the next day. Today, not so much. You can really see that sentiment is still weighing as the market kind of reprices what the future is going to look like if the terminal rate isn't actually at 5% the way the market was expecting. But it's not just the stock market, it's the bond market as well, and that's where you're seeing the bigger moves. Take a look at this, 417 on the 10-year yield, a move of almost 7 basis points that are already higher. And as you see those yields rise across the curve, by the way, a bond sell-off really underway here, the dollar follows. And you have that Bloomberg dollar index strengthening by about 0.6%. And we can't, of course, leave the commodity complex behind because a lot of those fiscal policies that we're worried about directly affects the likes of NYMEX crude, trading around with an 88 handle, down about 1.6%, Kailey.
All right, Kriti, well, there's also a lot of micro stories to pay attention to, and I'll start with one of the more positive ones, and that is Etsy reporting after the bell yesterday. Revenue that topped expectations for the period just reported. The forecast also came in line, and analysts say that's really positive against a pretty weak macro backdrop. As a result, it is up about 10% before the bell, but it is not a positive story for Roku, the streaming company, delivering a weak forecast, suffering from the slowdown in ad spending, so it's down about 19%. Qualcomm, the biggest maker of smartphone processors, is down about 7% as well on a weak forecast. It is getting hit by not just weaker macro backdrop, but also the COVID zero policy in China. And on that note, we have COVID zero policy persisting in China. China's top health authority doubling down on that, despite the rumors over the last several days that it may be eased. And of course, that had led to a market rally. Now that is reversing some today for some of those big Chinese stocks, including those here listed here in the U.S., including JD.com, down about 3% before the bell, Anna.
Yeah, we seem to have moved on, haven't we, from that Chinese excitement that lasted a couple of days, Kailey. This is what we see in Europe right now. The Stocks Europe 600 really responding to yesterday's trade on Wall Street, down by 0.8%. Technology stocks certainly to the fore. They're feeling a lot of the pressure, down by 1.7%, as, of course, higher interest rates becomes a slightly more global expectation on the back of what the Fed had to say, and that takes the edge out of some of those tech stocks. This is the euro gaining against the Norwegian kroner. The Norwegian kroner then losing ground, as we saw the central bank there, the Norges Bank, actually continue hiking, but hiking by less than had been anticipated. And what is interesting about that is if this were yesterday, if this were ahead of the Fed, we'd be asking questions about whether this was going to tell us something about what was to come from the Fed. It wouldn't have been the right question to ask, but I'm sure we would have asked it anyway. This is the pound, then 1.1% lower, 1.2% lower this morning. The pound in retreat, but really this is part of a strong dollar story, again in the aftermath of the Fed. We've had some data rounds on the UK this morning. UK October Services PMI coming in at 48.8. The prelim number there was 47.7, so it's better than the prelim, but it's still well below 50 in terms of the performance of the services sector in the UK. That suggests, Kailey, it is in contraction.
All right, Anna, well, let's get back to the conversation around the Federal Reserve. Joining us now is Danielle DiMartino Booth, a former advisor at the Dallas Fed, who is now the CEO and chief strategist at Quill Intelligence. So, Danielle, we all know it was not actually about the decision or the statement yesterday. It was about Chairman Powell and what he said at that podium over the course of the press conference. How would you rate his performance?
I think it was actually the best of his entire career. And his first press conference in 2018 was like 37 minutes. And I'm like, wow, this guy's not messing around. This blew that out of the water. He really was resolute. He was showing that he had full veto power. He basically dismissed the academics. He actually said the economists with reference to lag. And it felt like a me against them thing. It was for somebody who spent 9 years inside the Fed, I've never seen anything that extraordinary for him to literally abandon an entire Federal Open Market Committee.
Well, and essentially, if you distill his message, it was that, okay, we may dial back the size of hikes, but ultimately we're going a lot higher than you thought. What do you think that height is? How have you reassessed the terminal rate?
So I think something in the 5% range is going to be reasonable and realistic. What was bizarre was there was no summary of economic projections at this meeting, and yet he said that the terminal rate is higher than what it was in September. It was as if he was a one-man dot plot at the podium. So, and he brushed off the idea of the risk of over-tightening. Don't worry about that. I think one thing people have not picked up on, though, is Senator Sherrod Brown had been very critical. Right before the meeting, Powell has to pay attention to the employment mandate as well as the inflation. But during his comments, he said that fighting inflation was key to both to being able to maintain both of its mandates. Brushed off that criticism, which I don't think that many people picked up on.
Well, you mentioned the part that he kind of also brushed off the risk of over-tightening, and that's going to be a crucial part. What really stuck out to me was the fact that he said, it doesn't matter if we over-tighten because we can always cut after.
We've got those tools.
Right, and that's something that is kind of priced into the market. But I'm wondering, in the face of all this criticism that the Fed has cut too far or cut too long or waited too long and created this kind of a bubble in asset prices, it kind of feels like he was endorsing a technique that has come under such scrutiny. How is he going to follow through on that if they do indeed over-tighten?
He is trying to lay to rest lower for longer by being higher for longer than what anybody expects. And again, mistakenly, one of the reporters at the press conference asked him about the stock market being up, not knowing that the stock market had already turned tail. The minute he said premature, everything just went down. And he was just as resolute in answering.
He smacked that down.
He really, really did. I mean, I've never seen such a great performance out of a Fed chair. And if he was trying to channel his inner Volcker, I mean, he literally said, the body of knowledge and study on lags is, it's 40 years old or so, but it post-dates any era of inflation, so we don't necessarily have to incorporate it into our construct as we might have in a low inflation environment. I'm like, wow, you just dismissed Esther George, who might have dissented had the word lag not been added to the statement.
I'm old enough to remember when transitory was still in the vocabulary, as we all are. Chairman Powell was very confident about a year ago that this inflation would actually pass, of course, rescinding that in hindsight, But I think what's important to note here is that I believe as recently as this week, you've started to see cargo rates make a complete U-turn. You've seen wheat and rice prices now back to where they were pre-boost. Is any of this factoring into the Federal Reserve's kind of plan as perhaps a win?
Oh, I certainly think that, and he mentioned, extensive slowing here and there in the economy. He's recognizing that interest rate sensitive sectors are reacting to Fed policy. I don't think he thinks that they have reacted enough. And in addition to that, some part of me thinks that Powell is actually trying to break the mindset of the Fed put. If you're going to do that, you're going to hide behind the most lagging of all economic indicators. You're going to hide behind the very low unemployment rate, knowing full well that it's lagged, knowing inflation is also lagged. He's a lawyer. He's not a PhD in economics. He can follow real-time data just as well as anybody, and you saw that yesterday. But for now, I think he hides behind the shield of of a still too tight labor market and still too high inflation, despite what we've never seen anything this biblical in used car prices or this quick in housing prices. Housing's supposed to filter through to the consumer price index, Fannie Mae says, with a 5-quarter lag. It's barreled through in 2 to 3 quarters, which means at this time next year, we're going to be talking about, oh my gosh, prices are falling.
Okay. Danielle, can I ask you, good morning, by the way, can I ask you about the rest of the world? Because just as he dismissed perhaps the rest of the FOMC, he also dismissed concerns about the pressure that the rest of the world might be feeling from the strength of the dollar. And we see that once again today with a really strong dollar. He basically said that nobody is going to be better off if the US fails to tackle inflation. And that's it. What, end of conversation then about the strength of the dollar and what that does elsewhere?
Yeah, you know, it's kind of fascinating because we have 35 years or so of very cordial coordination between the world's central banks, especially in the post-quantitative easing, post-Bernanke era. And he really has been dismissive of the wrecking ball that the U.S. dollar has been in the rest of the world. I slept with one eye open last night, you know, trying to keep an eye on the yen. And that's where we're back to because of this attitude. It'll be fascinating to see what other people have to say here in the coming days, Fed officials.
Okay, yeah, keeping our eyes on the FX markets then. Danielle, thank you so much. Danielle DiMartino-Booth, CEO and Chief Strategist at Quill Intelligence, joining us there bright and early in New York. Don't miss our interview, thinking of central bank policymakers, don't miss our interview with Andrew Bailey, Governor of the Bank of England. Of course, the BOE's rate decision just a few hours away. And that conversation will be at 12 p.m. Eastern Time, 4 p.m. in London. Coming up next, Mick Mulvaney, former acting Chief of Staff for President Donald Trump. He's on tour. He'll be talking to our colleague Tom McKenzie and to Kailey shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Ralph Schlosstein, Chairman Emeritus at Evercore. That conversation at 12:30 p.m. Eastern, 4:30 p.m. in London. This is Bloomberg.
Ну, вже ж нас це турбує. Нас це просто не турбує, а лякає.
Well, of course we are concerned, but also when we talk about the concern, we can also talk about the fear, and the fear is not just not the fear of the country, it's the fear of what price could somebody pay for your life. That is scary when people choose whether it's worth to, you know, do it or not, and are bargaining for that, for the life as a price.
That was Ukraine's First Lady speaking with Bloomberg's Tom McKenzie yesterday at the Web Summit in Lisbon. She says her nation could perish if the world gives into fatigue with the war sparked by Russia's invasion. Tom McKenzie is back with us now, and he is joined by Mick Mulvaney, the former acting chief of staff for President Donald Trump. Tom, over to you.
Yeah, Kailey, thank you very much indeed. Yes, very pleased to say, joined by Mick Mulvaney here on the ground in Lisbon. As you say, Kailey, former White House Chief of Staff, someone who was in the room, of course, with Trump during that administration when that debate was going on about the handover of around $400 million in terms of aid. You gave testimony on this in Congress. We heard there from the First Lady of Ukraine speaking to me saying she is concerned that Ukraine fatigue is now setting in. Is that a legitimate concern, and how is it playing out in the U.S.?
Yeah, I think, morning, Tom, thanks for having me. I think it's a concern. I think the Americans, though, are looking more to Europe than people realize. Our resolve is pretty good. Yes, there's discussions now about whether or not we're giving too much money, whether or not the money is getting where it needs to go. Those are the right conversations to have when you're giving away your own taxpayer money. But one I don't think gets enough attention is the Europeans, not the British. The British have done a pretty good job in terms of ponying up to help the Ukrainians. But the Germans, the French, the Italians, the Spanish have done practically nothing. In fact, you could take almost all of continental Europe together, take out Poland, and Europe has given more than the rest of continental Europe put together. So I think if European resolve starts to waver, then American resolve might follow the same route.
We are starting to see divisions within the Republican Party. They could take the House, of course, and we'll get your views on this. But Kevin McCarthy, if he becomes head of the House, and then Senator Mitch McConnell, they have very different views on how much support to give Ukraine.
They do, but it's a healthy debate. It's should we give American taxpayer money to this country overseas? And there's times that the answer is yes, and times the answer is no. But keep in mind, if you make it us by ourselves or us with the British alone and the Europeans who live there, who are next door, who are right under Russia's doorstep, if they aren't stepping up, then the American taxpayer is going to stand back and say, now, why are we doing this? And the people that it impacts every single day don't seem to care. that is something that could change American opinion, public opinion, very quickly.
And what is your view? What is your forecast for the midterms?
For the midterms.
For the midterms.
For the midterms. Oh, I think it's a foregone conclusion at this point that the Republicans take the House. The lowest number I've seen would be Kevin McCarthy picks up 15 seats and becomes the Speaker of the House. I've seen projections as high as 32 or 34 seats going to the Republicans. Don't know if it'll be that good. If you want to watch an interesting race, watch the race for governor in New York. I've talked to Lee Zeldin a couple times. He really does have a chance. He's within the margin of error on a couple of polls, and the momentum seems to be going his way. If Lee Zeldin wins in New York, you're talking about a landslide the likes of which we've not seen since 2010 for the Republicans. So I'd watch that race early on Election Day.
Mr. Mulvaney, it's Kailey in New York. On the subject of the midterm elections, we heard from President Biden yesterday talking about election deniers and a democracy that is under assault. How much damage has been done to American democracy, to the American voting system since the 2020 election? And how could the midterms potentially exacerbate that if we do have candidates refusing to accept the results of their races?
Yeah, look, listen, January 6th was a dark time. There's no question about it. I've been a critic of January 6th for the last year at least. But for Biden to come out and use that as his closing argument, I think might give you some insight as to why a lot of folks are now saying it's going to be a red wave. The Democrats continue to avoid the conversations that swing voters, people who don't make up their mind into the last 30 days, which are the folks right now who are going to sort of determine the outcome of this election, want to talk about inflation and crime. The Democrats opened to talking about abortion, and they're closing talking about election integrity. Abortion and election integrity are critical. There's no question they're important topics, but it's not what voters want to talk about right now. So here again, I think Democrats have opened to talking about the wrong thing. They're closing talking about the wrong thing, and they may pay a serious price for it next Tuesday night.
Okay, so let's talk about policy then, because obviously it is the economy and inflation that is front and center in voters' mind. We have on the monetary policy side a Federal Reserve that got even more restrictive yesterday. They are tightening policy. What role should fiscal policy and Congress be playing in the face of what ultimately is going to be an economic slowdown?
Yeah, if you're talking about inflation being too much of supply and too much money chasing too few goods, the Federal Reserve is really good at destroying demand. It's what they're going to do by raising interest rates. They're already in the process of doing it. The Federal Reserve is not very good at increasing the supply of goods and services. That would be fiscal policy. That would be trade policy. That would be regulatory policy. I don't think you've seen this administration admit that yet. You're seeing re-regulating what Trump had deregulated, and it's making it harder to get goods and services to market. I also think you're going to see a situation where both parties will be willing to spend more money helping people during a recession, which is actually pro-inflationary. You just give them money, people money for not creating anything. For example, if you increase unemployment benefits. So yeah, you're in a circumstance right now where fiscal policy is going to be fighting against monetary policy. Washington, D.C., the elected officials will continue to do things that create pro-inflationary pressures, which could limit the effectiveness the Fed has on controlling inflation.
If the Republicans get the House, as you predict, as the polls suggest, what does that mean for the domestic policy of the Biden administration?
Yeah, I think if historically you look, when we do mixed government, one party holds the White House and the houses of Congress are split, we actually are a little bit more fiscally responsible. There's that sort of that balance. When one party's in charge of all, we spend a lot of money. Republicans spend a lot of money on defense, and when Democrats are in charge of everything, they spend a lot of money on welfare transfer payments. So when we get to split government, which is where we're going to be effective January of next year, I think you'll see a little bit more rational approach to the spending. It'll still be a tremendous amount of money. I don't think you could foresee a circumstance where the federal deficit is less than $1 trillion next year. I'd like to think that I'm wrong, but I just don't see it regardless of the outcome of the election. So you continue to have fiscal inflationary pressures despite what the Federal Reserve is doing on the monetary policy side.
Okay, we're here at the Web Summit, biggest tech event in Europe, so let's swing back to what's happening on the ground. I know you're involved in crypto, in the crypto space. I don't know if this is a dirty term, but you've been labelled by some as a lobbyist for crypto. When it comes to the regulatory environment in DC, a number of proposals going through on stable coins, on digital assets. How do you see that unfolding? Is it going to be positive for the industry?
It will be. What's happening in the legislature now is really good. There's very few things in Washington, D.C. that are bipartisan. Antipathy towards China is one of them. Antipathy towards big tech is another. But sort of support for DeFi, the decentralized finance, support for blockchain, these emerging technologies that are often driven by small businesses, as much of what this conference is all about, where we're here today in Lisbon. There's an interest in that. Cynthia Lummis has led in the Senate, but she's got Democrat support, at least to examine the topic. So I'm cautiously optimistic that Washington, D.C. is headed in the right direction. Problem is, right now, they're too slow. They're too slow in reacting to the world. I was just talking to the Lithuanian minister. They are ages ahead of us in terms of applying blockchain to government services. So a lot of the smaller countries around the world are doing better than we are. We've not been nearly nimble enough. I also think that regardless of what happens in Washington, the Biden administration is still going to be anti-crypto and anti-blockchain, and that doesn't change for the midterm election.
Okay, so your view that there needs to be some catch-up from the US and regulators there. Mick Mulvaney, thank you very much indeed. Of course, former White House Chief of Staff to former President Donald Trump. Kailey, back to you.
All right, and thank you to you, Tom, for joining us with Mr. Mulvaney at that summit in Lisbon. Appreciate your time for both of you. And coming up later today, don't miss Tom's interview with the co-founder of Airbnb. That's coming up in the European Close later on today. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off. Let's take a look at what's going on ahead today. G7 foreign ministers meeting in Germany with Russia's invasion of Ukraine sure to be among the biggest topics. Peloton's earnings results are released before the market opens. Of course, all eyes on those shares. And it's the Bank of England's rate decision at 8 a.m. New York time, where it's expected to deliver its biggest interest rate increase in 33 years. Anna, it's going to be fascinating to see if, even with this historic rate decision, you do actually see some movement in the currency space, if pound actually weakens or rises.
Yeah, absolutely. I mean, it's weak already. It's funny, we were having a conversation earlier about whether this is historic. It is the biggest in, 33 years? I don't know. How do you define history these days? But since 1989, we haven't seen a hike of this size, Kriti. But we are seeing the pound much weaker, down by 1.3% right now. And that's before, Kriti, we might potentially get some disappointment from the Bank of England. You don't know. If they didn't hike by 75 basis points, you'd expect the pound would weaken quite substantially.
Yeah, and it's fascinating to see what that does in reverse then to the dollar, Kailey, and really you start to see the ripple effects once again from the dollar read-through.
Well, the dollar, at least right now, pre-BOE, is strengthening substantially, higher by about 0.6% on the Bloomberg Dollar Index, and you're continuing to see the big moves in the bond market, Anna. The 10-year yield up another almost 9 basis points today after rising yesterday. We're back up at the 4.19 level because the message from the Fed was even if we get a step down and the hikes are smaller, we're going farther. It is a repricing of the terminal rate that this market has to contend with.
Absolutely, all about the terminal rate. And how long do we remain in that post-Fed trading environment? Is this something that lasts hours? Does it last days? We've got the jobs report tomorrow, of course. Will that tell a similar tightening story, perhaps, if the jobs market remains strong? That is it for Early Edition. Surveillance is up next. This is Bloomberg.